the eligibility requirement for an initial public offer. Now, we had gone through and understood all the financial norms which a company must, have. They should be having, some tangible assets. They should be, profitable for the last 3 years. They should have some net worth. So we've done all those kinds of, eligibility financial norms, and some non-financial norms, that there should not be any case pending against the company. The director should not be barred from, entering into the security market. So SEBI should not bar them. So if, a company is able to meet all the requirement, then they are allowed to go for an IPO. But then there is another thing that, if a company is not able to meet the financial norms, that means they are not profitable, or they are, loss-making companies, in past companies like, Paytm, Zomato, they had not gone into become fully profitable, but they came with an IPO. So this is called alternate eligibility. Some companies are allowed to tap the capital market and raise money, but there are stiff conditions. So an issuer not satisfying the stipulated conditions, those conditions which we have covered last time, shall be eligible to make an initial public offer only if the issue is made through book building process. And today we are going to understand in detail what is a book building process. An issuer undertakes to allot at least 75% of their net offer to qualified institutional buyers, and to refund the full subscription money if it fails to do so. Okay, so which means that the company should first of all adopt a book building process. Okay, they can't issue shares without book building process if the company is not in profits. And the issuer undertakes to allot at least 75% of its shares to the QIBs, that means the qualified institutional buyers. So there are 13 such class of institutions like mutual funds, LIC, or insurance companies, or pension funds. They can go and they can be allowed, they can participate in such kind of companies public issue who are loss making public issue. So at least 75% money should be taken from them. And if the company is not able to meet these requirements, then they should refund the full subscription. If they fail to do so, then they have to refund. Okay, so this is what we covered last time, and we will be talking about this more in detail. Now, what are the additional conditions for an offer for sale? So whenever the promoters or any big investors, they are offering their own shares, that means they are diluting their own holdings in a company. So it's a company which is a private company or a public company where public is not holding any shares. So those companies come for an IPO, so they become a listed public company. So before they become a listed public company, or they are just a private company, so they are shareholders. Now those shareholders, some of the shareholders would like to either dilute their holdings or completely exit from the company. So they can offer their own sale along with an IPO. Okay, so it can be even sometimes it's like 100% offer for sale, like an LIC offer. LIC India came with a public issue long back, or IRCTC, which is again a government company. So they offered 100% of the shares, and 100% of shares were held by the government of India. Of course, they never loaded 100% this thing, but they loaded only 25% of their holdings, or 10%, 25%. We have to look at the case. So they offered, all the shares were offered to the public was for offer for sale. So in this case, the money which was collected by issue of this IPO had actually, was transferred to the government. Of course, IRCTC and LIC collected that money, and the money was transferred to Government of India. So it was their part of the disinvestment plan. Okay. So shares must be fully paid up. The first condition is that all the shares should be fully paid up. So fully paid up means what? Janardhan, Ananya, or anybody, Navya, Sophia, or anyone who is present there? Shares must be fully paid up. What does it mean? Anyone can answer. So shares must be fully paid up means that the shares, if it's a 10 rupee share, then all the money should have been collected by the company from its shareholder. Sometimes, companies collect in installments. In earlier days, they used to collect 2 rupees along with the application, 5 rupees at the time of allotment, and final call or first call like this, the money should be collected. Now, of course, that process now is still there, but nobody does that. So all the money is collected, upfront. So shares should be fully paid up. Okay, all the shareholders, they should have paid full money to the company. If it has done, they have done, then they can go for an IPO. Shares shall be held by the sellers for a period of at least 1 year prior to the filing of the offer document. That means these shares should be held by them at least 1 year before the company goes and files the offer document to the SEBI. Okay. So if you are holding a share for last, say, about 3 months back as a promoter, you can't offer that for sale. So you should at least hold the shares for 1 year. Okay. Is that clear to all of you? In case the equity shares received on conversion or exchange of fully paid up compulsory convertible securities, including depository receipts, are being offered for sale. So even if they are convertible shares, they can be again offered for sale. If they are convertible bonds or debentures and they have been converted into shares, so those can be also offered for sale. But the holding period for such convertible securities, including depository receipts, as well as that of the resultant equity shares together, shall be considered for the purpose of calculation of 1 year. Suppose the company has given a convertible debentures. So which means that these shares will be converted into shares at a later date. Now, suppose in the last year they were converted into shares. So even the time when the company had the period in which the shareholders, the debenture holders were holding those debentures, that will be also counted for the period of 1 year. Suppose the company has done conversion a month before the IPO. So it will be still considered as 1 year if those shares were held by more than 1 year in form of convertible debentures. Okay. So additional conditions. Ananya, can you read?
Further, such holding period of 1 year shall be required to be compiled with at the time of filing of the draft offer document. If the equity share arising out of the conversion or exchange of the fully paid compulsory convertible securities are being offered for sale, the conversion or exchange should be completed prior to filling of the offer document, that is red herring
Prospectus.
in the case of book build issue and prospectus in the case of fixed price issue, provided full disclosures of the term of conversion or exchange are made in the draft offer document.
So what it says is that if the shares which have been come out of the conversion, if suppose company had convertible debentures and the company has converted them into shares, okay, for the persons who are holding convertible debentures, now they can be offered for sale, okay, and they before completion the conversion of exchange should be completed prior to filing of the offer document. That means the conversion should have been done before filing the offer document or the prospectus. Okay, that means if you are going for an IPO and you are holding some convertible debentures, which means they can be converted into shares, so company must do that conversion before they file an offer document, okay, to the SEBI or for making an IPO offer. Now that offer document is called a red herring prospectus. Now you should be well versed with the full term and how to pronounce it. It should be red herring prospectus. Okay, in case of book built issue, and prospectus in case of a fixed price issue. So I told you last time that the final prospectus is called the prospectus. Okay, which is basically filed with the registrar of the companies. Before it becomes a prospectus, if a company is issuing shares on the basis of book build, that means they are making a price band. That means shares are offered in a price band and where shareholders or the prospective shareholders can make bids. So at that time, since the price is not known and neither the company has declared how many shares they are going to issue, okay, but overall they know the company is going for a 1,000 crores of issue, but neither the price is fixed because the price band is being offered, nor the total number of shares the companies are going to issue, which will depend again on the price band. at what their company is going to offer, ultimately at what price they are going to offer. Then only the number of securities will be determined. Okay, so at that time, the prospectus is called a red herring prospectus. So it is called a red herring prospectus, which does not contain the price of the share. It only contains a price band. It does not contain the exact number of shares which are going to be offered to the public. Okay, so it is called a red herring prospectus. Now, this is only in the case of a book built issue, okay, where the company is issuing up offering shares on the basis of price band. If the company is issuing a fixed price issue, which means the company has fixed the price, that means they are not going for book build, which would normally means the company is profitable. So they have met all the eligibility criteria and they are fully profitable. So they have decided to bypass the book build kind of a mechanism and fixes a price. So in that case, it will be called a prospectus and not a red herring prospectus. Okay, just read this, Ananya.
The offer for sale of a government company or statutory authority or corporation or any specific purpose vehicle set up and controlled by any one or more of them which is engaged in the infrastructure sector.
Okay, hold on. So this is a non-applicability. So the offer for sale of a government company or a statutory authority or a corporation or any special vehicle set up or controlled by one or more which is engaged in infrastructure. Now, for such companies, it is not applicable. Okay, so they can just go for it. Without meeting the criteria which we have discussed. Okay. Read further.
Equity shares offered for sales were acquired pursuant to any scheme approved by a high court or approved by a tribunal or the central government as applicable in lieu of business and invested capital which had been in existence for a period of more than 1 year prior to approval of such scheme.
Okay, now what is this scheme? Okay, so what I have done is that I have just given an example. An example is merger of Reliance Petroleum Limited with Reliance Industries. Now, Reliance Industries is a big company which is owned by Ambani's, Mukesh Ambani Group. So there was a merger of a company, another company which was owned by Mukesh Ambani Group, which is Reliance Petroleum Limited. So example is a merger of Reliance Petroleum Limited with Reliance Industries in 2009. The merger was approved by High Court, where RPL, which is the Reliance Petroleum Limited, shareholders received equity shares of RIL. That means Reliance Industries in exchange of RPL holdings. So Reliance Petroleum had been an established business for over a year before the merger was proposed. Now, this is actually what the second box says, that if Reliance Petroleum Limited shareholders got shares of Reliance Industries, okay, and this company was in existence for over 1 year, more than 1 year before this happened, and this merger was approved by High Court. Okay, so if this is the case, then this offer for sale, these shares which are offered for sale will comply with this because they have been approved by the High Court. Okay, now, okay, just read this.
If the equity shares offered for sales were issued under a bonus issue on securities held for a period of at least 1 year prior to the filling of the draft offer document with the board and further subject to the following: such specified securities being issued out of free reserves and share premium existing in the books of account as at the end of the financial year preceding the financial year in which the draft offer document is filed with SEBI, and such equity shares are not being issued by the utilization of revaluation reserves or unrealized profit of the issuer.
Now, if a company has what we are actually doing is that we are talking about additional conditions for an offer for sale. Okay. Now, if the bonus shares, the company can issue bonus shares. Okay. Now, if the company has issued bonus shares and the promoter or any big shareholder is selling that bonus shares as a part of offer for sale, he can do so only under the condition that the shares should have been issued out of the free reserves or a share premium which are existing in the company's books of account, and not from the revaluation reserve or unrealized profits of the company. Which means, if the company, have you heard what is revaluation reserve? Now I just going to explain that revaluation reserves are created by the company by revaluing their assets. For example, if there is a company which has bought a building, about 20 years back or 50 years back at 1 crore. Today the building is say 10 crores. So company can increase the value of its asset to 10 crores in the balance sheet, and they will show those 9 crores as a part of the revaluation reserves. Now if the company uses those revaluation reserves for issuing bonus shares, now those bonus shares will not be eligible. Okay, if they have been created out of the revaluation reserve. Okay, but if you have created, if you have issued bonus shares and it has been created out of the free reserves, that means out of the reserves which are available as general reserve which is available in the balance sheet. Okay, I'll just show you this thing, a balance sheet. Okay, to just to clarify the point here. So just open a site called Screener again. Recently, Reliance has issued bonus shares. Okay, so we'll go to Reliance. So Reliance shares currently are traded at 1339. Okay, now just a few days back Reliance was trading at 2600. So Reliance has given 1:1 bonus. Okay, so if you look at the balance sheet here, so we'll find the company has reserves 8 crore 12. Are you seeing this balance sheet of Reliance on your screen, Janardhan? Or Ananya, can you see this on your screen?
Yes, sir.
Now, how much reserves Reliance is having? Anyone? 8,12,000 crores. Now, these are called the free reserves. Okay, fine. Of course, you have to look at the breakup of the reserves. Now, breakup of the reserve is not given. So, if these reserves are created out of revaluation of assets, okay, then Reliance cannot issue bonus shares. They can issue bonus shares, but they cannot sell those shares. Reliance, whatever share the Ambanis are going to hold, they can't offer these for offer for sale. Only if they have been issued from the free reserves. Okay, so that is the explanation. I hope it is clear. So you can just understand it more clearly, and you can Google it if you are not understood still. Okay, so I'm just going to open now. So let me see. We have Ananya, Janardhan, Chokalingam. Are you there? Nitasha, are you there?
Yes, sir.
Okay. So Nitasha, you're going to read next time when I'm going to tell you. Okay, and then Chokalingam also. Dhruvkarsh, are you there?
Yes, sir. I'm here, sir.
Okay. Dhruvita,
Yes, sir, I'm here.
Ida.
Yes, sir.
Okay. Janardhan is there. Jasraj,
Yes, sir.
Krish,
Yes, sir. I'm here.
Malaika,
Yes, sir.
Nandini,
Yes, sir, I'm here.
Navya.
Yes, sir, I'm here.
Okay, and okay, Nandita is there, Navya is there, Nilesh,
Yes, sir. I'm here.
Nyashi,
Yes, sir.
Pranika,
Yes, sir.
Petty.
Yes, sir, I'm here.
Okay, Jayati, okay, I remember you. Pratham,
Yes, sir. I'm there.
Syed,
Yes, sir, I'm here.
okay, Sana, Shailja,
Yes, sir, I'm here.
okay, Srujan,
Yes, sir. I'm here.
Vikash.
Oh, yes, sir. I'm here.
Okay, so all of you be attentive. So I am going to ask you anyone to read the slides. Okay, so you should be all there. Okay, fine. So let's go back to the slide now. So is my slide visible, Nitasha?
Yes, sir, it's visible, sir.
Okay. Okay. So Nitasha, we talked about bonus issue. Okay. Now this is coming under the offer for sale. So any promoter or a big shareholder of the company can offer their bonus, I mean the shares which were given to them as part of the bonus issue of the company. Now the bonus issue should happen out of the free reserves and not out of the revaluation reserves. So only if the company has issued the shares out of the bonus issue, out of the free reserves, in that case only those shares will be applicable for offer for sale. And the shares which have been issued from the revaluation reserves, they will not be considered for offer for sale. Now tell me an example which I gave. Revaluation reserve is created out of what? How the revaluation reserve is created? Anyone? How can a company create a revaluation reserves in their balance sheet? Can anyone tell me? Ananya? Balaji? So I'm just again repeating, okay, be attentive because I am going to ask you questions. Now, revaluation reserve means that you are revaluating your assets. Now, company might have be owning a lot of assets, whether they are plant and machinery, equipments, buildings, land. Now, companies, if they are holding those assets, they can revalue those assets periodically, and can increase their balance sheet. This thing, suppose the assets have gone over the value have increased. For example, land value, building value, land and building. Okay. Now land generally appreciates. Okay. So suppose a company had bought a land at say 1 crore about a couple of years back, and today the land price have gone up to say 10 crores. So there is an appreciation of 9 crores in the value of the land. Now company may, again, similarly the things can happen in case of plant and machinery and other assets also. So company can revalue their assets. And any amount which is being generated, like in case of a land, the land was bought at 1 crore, now the market value of the land is 10 crores, so company can show a value of 10 crores in the balance sheet instead of 1 crore. Now if the company has shown 10 crores on the asset side, which the company purchased the asset for only 1 crore, so how they are going to account for that 9 crores additional which they are showing in a part of the land and building? So they are going to show that as reserves on the liability side. On asset side, the land and building will go up by 9 crores, so it will go up to 10 crores. On the liability side, a free reserve will be created, a reserve will be created, and that reserve is called the revaluation reserve. Okay, so you can just go to the Google and try to find out what is a revaluation reserve. Okay, so I'm just going to do that for you. Okay, revaluation reserve. So I'm picking up this revaluation reserve and going to here and saying what is the revaluation reserve. Okay. So revaluation reserve. So Nisha, just can you read, Sophia?
Yes, sir. Revaluation reserves are a line item on a company's balance sheet that accounts for changes in the value of its long-term assets. They are often used when an asset's market value is volatile or fluctuates significantly, such as due to currency relationships.
Okay. So here, just hold on. Okay, I'm just going to check with. Okay, fine. So revaluation reserves are created when you are revaluing the assets of your company. Okay, revaluation reserve of land, I can say. Then I think. Example. Okay, you can just look for some examples later on. So and we will just continue with the lecture. Fine. So you can just look for some examples of your own later on. Okay, just read this, Nisha.
Issues of warrants Regulation 13. An issuer shall be eligible to issue warrants in an initial public offer subject to the following. A. The tenure of such warrants shall not exceed 18 months from the date of their allotment in the initial public offer. B. A specified security may have one or more warrants attached to it.
So companies can issue warrants along with an IPO or FPO. So whenever a company is issuing shares, they can issue warrants also. So issuer shall be eligible to issue warrants in an initial public offer subject to following. The tenure of the warrant shall not exceed 18 months. Okay, so that means these warrants should not be beyond 18 months. So they should be for only up to 18 months. A specified security may have one or more warrants attached to it. So that means you can attach either one or more warrants. So what are warrants, for example? Okay, so example of Tata Motors. Okay, just read this.
When not an IPO, the Tata Motors 2015 rights issue is a relevant example where warrants were issued alongside equity shares, showcasing how this structure works in India's capital markets. Here's how it aligns with SEBI's warrant guidelines. Offering warrants with equity shares, Tata Motors issued partially paid up equity shares and detachable warrants to its existing shareholders in the rights issues. Although this was a rights issue, the structure aligns with the IPO warrant guidelines, demonstrating how companies might use warrants to enhance investor value.
Now, you know what happens? The companies can issue a warrant, which means it will say that these warrants will be convertible into shares at a later date. So whenever the companies are offering shares in an IPO or an FPO or a rights issue, they can attach warrants. So this will increase the the appeal to the IPO. When you apply for an IPO or an FPO, so if you get some warrants which will be converted into shares at a later date, so this is an additional shares you will be getting after some time. Okay, so that is called a warrant. Okay, read further, Sophia.
Sorry, sir, I didn't realize I was on mute. Fixed exercise price and tenure. Each warrant came with a specific exercise price and a tenure, after which the warrant could be converted into a fully paid up equity share. In this case, the tenure was 3 years. Eligibility and compliance. Tata Motors adhered to SEBI's eligibility and compliance requirements for warrants, including disclosures and approvals, which would also apply in an IPO context.
So that means, a fixed, shareholders can exercise their right to, subscribe to these warrants, and they will pay the money which was fixed at the time of issue of the warrant. So what are stock warrants? A warrant is a right to buy a specific number of shares from a company at a certain price in future. Okay, so this is like a stock warrant, okay, which company is going to issue along with its IPO or an FPO. Generally it happens normally with a FPO or a rights issue, very rarely with an IPO. The warrant is a right to buy a specific number of shares from a company at a certain price in future. Now the price formula for determination of the exercise price of the warrant shall be determined upfront and disclosed in the offer document. And at least 25% of the consideration amount based on the exercise price shall also be received upfront. So the companies issuing warrants, they should tell at what price or what is the formula at which the price will be calculated right upfront, and the 25% of the amount should be received along with the issue of the warrants. Okay. In case the warrant holder does not exercise the option to take the equity shares against any of the warrant held by the warrant holder within 3 months from the date of payment of the consideration, such consideration made in respect of such warrant shall be forfeited by the issuer. Now, because this 25% was collected at the time of issuing the warrants. Okay. Now 75% was supposed to be made after some time. Now, suppose the payment has fallen due for the warrant. Now the shares will be issued to the warrant holder. Now, if the warrant holder has paid 25% but fails to pay the balance amount, which is 75% within 3 months, then the 25% which has been collected by the company will be forfeited. Okay, so that will become the gain for the company, and there will be no shares will be issued against that warrant unless the warrant holder has paid the balance amount also. Okay, so now we come to the regulations. Okay, IPO and FPO. Now the regulations are covered under ICDR 2018. That means, this is the regulation issued by the SEBI. Okay. Now the regulations number 4 to 55, talks about IPO, and 101 to 131 regulations of the ICDR rules apply for FPO. Okay. So almost all these two regulations are identical in nature, but there are some changes because IPO, the SEBI is more stringent, and the rules are more elaborate. In FPO, the rules comes down a bit because this is the second time when a company is issuing the shares. So first time the SEBI makes the rules more strict and covers a lot of provisions, but those provisions become a little lesser in an FPO. Okay. So filing of an offer document. First is the company must file an offer document. The first process is we are talking about an IPO. Regulation number 25 IPO, regulation number 123 FPO. So a company which is issuing share for the first time will be under regulation 25, and 123 will be for a company which is issuing shares as a FPO. So regulation number 123 is covered. Now rules are exactly identical. Okay, Sophia, can you read this?
Yes, sir. Prior to making an IPO or FPO, the issuer shall file 3 copies of the draft offer document with SEBI with fees as specified through the lead manager or managers.
Okay, the first is that before you make an IPO or FPO, so the company which is coming with this IPO or FPO, they should file at least 3 copies which are called the draft offer document with SEBI along with the fees. Okay, as specified through the lead manager. Now, who are the lead managers? Anyone? Who are the lead managers?
So the merchant banks and the investment banks.
Absolutely. So lead managers are nothing but the merchant bankers. So company must appoint a merchant banker before they go for an IPO. Now they are also called the lead managers. Okay. So a company must file first an offer document, 3 copies, along with the fees, and they should file it with the SEBI. Okay, Natasha, can you read?
Yes, sir. The issuer shall also file the draft offer document with the stock exchanges where the specified securities are proposed to be listed.
So next, slide will be read by Sana Dogra. Okay, the issuer shall also file with the issuer shall also file the draft offer document with the stock exchange. That means the issuer should file, first they should file with SEBI, okay. Second, they should file an offer document with stock exchange where the specified securities are proposed to be listed. So first they should file with the SEBI, which is called a draft offer, because it has not still become a complete offer document. The SEBI has not approved it, so they must file a draft copy of the draft document also with the stock exchange, okay, where the securities are going to be listed. Okay, Sana, can you read this? Or Navya, Malaika, anyone?
And submit to the stock exchanges the permanent account number, bank account number, and the passport number of its promoters, where there are individuals.
So now they have to submit to the stock exchange the permanent account number, the bank account number, and the passport number of the promoters where there are individuals. Now the promoters can be individuals or they can be even companies. So if the promoters are individual, so the company must file the permanent account number, bank account number, and passport number of their promoters. Next, who is reading?
Malaika, sir.
Malaika, yeah. Malaika, read.
And permanent account number, bank account number, company registration number or equivalent, and the address of the register of companies with which the promoter is registered, where the ROC promoter is a body corporate.
If suppose the promoter is not just an individual, it's a body corporate. For example, ICICI Bank doesn't have any single promoter. Okay, so they have the body corporates as their promoters. So then in that case, they have to give the permanent account of the company or the bank account number of the company. Okay, so that is the case. Okay, now read further.
The lead manager or managers shall submit the following to the SEBI along with a draft offer document. A certificate confirming that an agreement has been entered into between the issuer and the lead manager.
So first, a certificate. The lead manager shall submit a following to the SEBI along with a draft offer document. That a certificate confirming that the agreement has been entered between the issuer and the lead manager. So that means the company has hired a merchant banker and there is an agreement between the company and the lead manager, that is the merchant banker. So this certificate should be filed with the SEBI that the company has complied with ICDR regulations, okay, and they have gone with the appointment of a merchant bankers. Next.
A due diligence certificate.
Now, due diligence certificate is basically, a kind of an audit, which is conducted by the merchant banker. That all, they have gone through that all the regulations the company has complied with, okay, of the ICDR. Okay, so there are so many regulations of the ICDR. So the company has complied with all the regulations. So the lead manager or the merchant banker should submit a due diligence certificate. Okay, complied with all disclosures and verified the compliances. So if you look at the bottom, so this is the meaning of due diligence certificate here. Okay.
In case of an issue of convertible debt instruments, a due diligence certificate from the debenture trustee.
Now, if the company is coming with a convertible debt instruments, okay, fine. That means they are offering bonds which will be converted into shares later on. In that case, a due diligence certificate from the debenture trustee is also supposed to be filed. Okay.
A debenture trustee is a financial institution or a trustee company appointed to protect the interests of debenture holders in cases where a company issues debentures or other convertible debt instruments.
So basically, debenture trustees are appointed whenever a company is issuing bonds or debentures. Okay, it is just to protect them. Okay, fine. So there is an example here. So I'm just going to skip. You can just read it yourself. Okay, fine. Read further.
SEBI may specify changes or issue observations on the draft offer document filed with it within a period of 30 days from the later of the following weeks.
So, once the SEBI receives the offer document from the company, then the SEBI has to approve that offer document so that the company can go ahead with an IPO. Okay. So, SEBI may specify changes. Now, it may ask for some changes to be made on the offer document and they can issue some observations on the draft offer filed with it within a period of 30 days. So, SEBI has to make specify the changes or issue observations within the period of 30 days from later of the following dates. Okay. So, it will be 30 days, within 30 days of the following dates. First, read this.
The date of receipt of the draft offer document filed with SEBI or.
So, that means the SEBI has to issue or make changes or issue observation within 30 days of the date of receipt of the draft of document with the SEBI. So, if the company has filed the offer document today, okay, then within next 30 days, SEBI must make some specify the changes or issue their observations. So, this is number one. Number two,
the date of receipt of satisfactory reply from the lead merchant bankers, where SEBI has sought any clarification or additional information from them.
Now, suppose the company has filed a draft offer document. Now, SEBI has immediately, within a certain period, they have issued some, observations. Now, lead manager is supposed to offer explanation to these, observations. So, the date of receipt of satisfactory reply from the lead merchant bankers where the SEBI has sought any clarification or additional information from them. So, in case if SEBI has sought any further information from the lead managers and the lead managers has filed the reply, so the 30 days period will start from this date. Okay, after the reply was submitted by the lead managers. Okay.
The date of receipt or clarification or information from any regulator or agency
where SEBI has sought any clarification or information from some regulator or agency.
Now, SEBI can seek some clarification from the regulators. Like, we have regulators like Reserve Bank of India, IRDA, insurance, like IRDA or RERA. So, if suppose SEBI is seeking some clarification from the regulator or the which regulates that industry, okay, or any other agency. So, once that reply has been given, okay, then from that day, 30 days will start.
The date of receipt of a copy of in-principle approval letter issued by the recognized stock exchanges.
So now the stock exchange must also give their approval, okay? Because the company will file a document with offer document with the stock exchange, and stock exchange will say, okay, we give you an in principle approval that you can come and issue your shares through this stock exchange, and we will list your shares. So once they have given the approval, so from that day 30-day period will be starting. Okay, so 30 days period will be later of the following dates: number 1, number 2, number 3, number 4. Okay, just read further. Malaika.
If SEBI specifies any changes or issues, observations on the draft of a document filed with it, the issuer and the lead merchant banker shall carry out such changes and comply with the observations issued by SEBI before registering the prospectus, the red herring prospectus or the shelf prospectus, as the case may be, with the Register of Companies or an appropriate authority as applicable.
So if SEBI specifies any changes or issues any observation on the draft of the document filed with it, the issuer and the lead manager shall carry out such changes and comply with the observations issued by SEBI. Okay, so first of all, they should comply with that, and after that, they should go for registering this prospectus or red herring prospectus, or it is called the shelf prospectus, with the Register of Companies, okay, or an appropriate authority. Now, after the SEBI gives, after the lead managers or the company has carried out the changes and done everything, then the company needs to file this prospectus. It may be called simply a prospectus or a red herring prospectus or a shelf prospectus, okay, with the Registrar of Companies. Now, what is a shelf prospectus? Now, shelf prospectus are issued generally by financial institutions, because they can offer multiple time shares to the public. Okay, so each time when a company is issuing shares, they have to issue a prospectus or an offer document. But banking companies are not required to do so. They can just submit a shelf prospectus. Okay, fine. So that will be treated as a prospectus for multiple issues. Okay, read this.
The draft of a document filed with SEBI shall be made public for comments, if any, for a period of at least 21 days from the date of filing, by hosting it on the websites of SEBI, stock exchanges where specified securities are proposed to be listed, and lead managers associated with the issue.
Okay, so that means the draft of a document filed with SEBI shall be made public for comments. So the draft of a document should also be, published on the website of SEBI, stock exchanges, or the company's website, okay, by the lead managers, so that public can make any comments they want before the company can issue shares and offer shares to the public. So public will be also be apprised of the company is coming with an IPO. Okay, the issue, yeah.
The issuer shall, within 2 days of filing the draft of a document with SEBI, make a public announcement in one English national daily newspaper with wide circulation, one Hindi national daily newspaper with wide circulation, and one regional language newspaper with wide circulation at the place where the registered office of the issuer is situated, disclosing the fact of filing of the draft of a document with SEBI and inviting the public to provide their comments to SEBI and the issuer or the lead manager in respect of the disclosures made in the draft of a document.
So that means how the company is going to tell the public. They are going to make an announcement in the newspapers. Okay, and both English, Hindi, everything. Okay, so they'll ask for comments from the public. Okay, read further.
The lead manager shall, after the expiry of the period stipulated above, file with SEBI details of the comments received by them or the issuer from the public on the draft offer document during that period and the consequential changes, if any, that are required to be made in the draft offer document.
So the lead manager shall, after expiry of the period stipulated above, file with the SEBI details of the comments. So now all the comments which have been received from the public, they should be filing all these comments with the SEBI. Okay.
The issuer and the lead manager shall ensure that the offer documents are posted on the website as required under these regulations and its contents are the same as the versions as filed with the registrar of companies, SEBI and the stock exchanges as applicable.
So all, when the companies are filing the offer document, then the versions which are there on the stock exchange with the registrar of companies or with the SEBI, they should be same. There should not be any deviation, in the version of these documents. Okay.
The lead manager and the stock exchanges shall provide copies of the offer document to the public as and when requested and may charge as reasonable sum for providing a copy of the same.
So any public or any person can ask for this document, okay, and the company has to provide free of charge. Now we come, we have just covered that. Now we come to some important provision, ASBA. Okay, we have talked this. What is ASBA? The issuer shall accept bids using only ASBA facility in a manner specified by SEBI. Now, of course, ASBA has been now done away, okay, for certain category of investors. Earlier, all the retail investors were, using ASBA facility, okay. So now the ASBA stands for application supported by blocked amount. So that means you make an application through ASBA route where your amount will be blocked. Okay. Earlier you were paying check or physically the money was moving to the company, and if you are not allotted the shares, you are getting refunds. Now the whole process has been streamlined. So it is application supported by blocked amount, which means application for subscribing to public issue or right issue along with authorization to self-certified syndicate bank to block the application money in the bank account. So if you have applied for shares of a company, suppose for 2 lakh rupees, so your 2 lakh rupees will be blocked in your account till the issue is decided by the company who is going to get the shares. Okay. So because company may receive a lot of applications, so till the time company allots the shares, the amount will remain blocked. If the shares are issued to you, the block will be removed and the money will go to the company. And if you don't get the shares, then the block will be removed. You are free to use the amount in your bank account. Under ASBA process, instead of moving the application money from the bank account of an applicant to in an IPO to an escrow account, the same is blocked in applicant's own bank account. So just read the last third one. Okay, Sana, can you read this? Sorry, Malaika, can you read the third one?
Under ASBA process, instead of moving the application money from the bank account of applicant in an IPO to an escrow account, same is blocked in applicant's own bank account, and if he receives shares in IPO, same is released to the issuer company.
So now what happens is the money will go to the escrow account of the company after the company has allotted shares. Okay, so escrow account is basically an account generally where the company cannot withdraw any money till the whole of the process of the IPO is complete and the merchant bankers gives a certificate to the stock exchange that the process has been done with, and then the money can flow into the main account of the company, and company can use the money. Till that amount, till the time, it is called escrow account. So it is just a parking money where the money is parked, for a while till the company fulfills all its regulation conditions. So in ASBA, what happens is the money will move to the escrow account if you get your shares. If you don't get your shares, then the block will be removed and you are free to use that money. Okay. Now we have UPI. Okay. So UPI has become now mandatory. ASBA is applicable only to very few categories of the investors or shareholders, okay, or the prospective shareholders. Can you read this, Malaika?
Individual investors can use UPI for up to 5 lakh payment in public issuance.
So UPI is only applicable up to 5 lakh. For rest of the categories above more than 5 lakhs, ASBA is still applicable. So all the individual investors, they can't apply more than 2 lakhs or HNIs can apply up to 5 lakhs. So for them, the limit is that they have to give the money through UPI. Okay, read this.
Individual investors applying in public issues of equity shares and convertibles can use Unified Payment Interface (UPI) for application amount up to rupees 5 lakh.
So now the individual investors applying the public issue of equity shares and convertible can use UPI. Okay, okay. UPI is mandatory now. Okay, read this.
In use of UPI as a payment mechanism in public issues, mandatory. Yes, UPI mechanism is mandatory for all applications made by individual investors through the intermediaries, provided the application amount is up to rupees 5 lakhs. Are all categories of investors eligible to apply in public issues using UPI for payment? No. Only individual investors are allowed to use UPI for payment in public issues as retail investors and non-institutional investors.
So this UPI is only meant for individual investors or non-institutional investors who are basically the persons who are having who have deep pockets. They are individuals, or they can be HNIs. Okay, fine. So we'll talk about what is non-institutional investors in our later slides. Okay, security deposit. Okay, now whenever the company is coming with an IPO, so they need to deposit a security deposit with the stock exchange. Malaika, can you read?
The issuer shall, before the opening of the subscription list, deposit with the stock exchange or stock exchanges an amount calculated at the rate of 1% of the amount of the issue size available for subscription to the public in the manner as may be specified by SEBI, and the amount so deposited shall be refundable or forfeitable in the manner specified by SEBI.
So that means all the companies, before they go for a IPO or an FPO, they must deposit 1% of the issue size. Now stock exchange can always, the amount can be forfeited if the company is not comply with all the regulations. If the company's IPO is successful, the 1% deposit will be, security deposit will be refundable to them. Okay. Opening of the issue. Read this.
A public issue, both IPO and FPO, may be opened within 12 months from the date of issuance of the observations by SEBI.
So there is an opening of the issue. That means once the SEBI has given a clearance, it has cleared the the offer document and all the formalities can be done. Now companies can open the issue. So a public issue, both IPO, FPO, may be opened within 12 months from the date of issuance of the observations by SEBI. So if the SEBI has approved and given after completing all the observations, then the company can issue shares to the public within 12 months from the date of issuance of the observation SEBI. So if the SEBI gives approval, within 12 months, the maximum period which is allowed to the companies to go for the public is 12 months. If they are not done, the company has to file a fresh application or a fresh offer document.
In case of a fast track issue, the issue shall open within the period specifically stipulated under the Companies Act 2013.
Read further.
In case the issuer has filed a shelf prospectus, the first issue may be opened within 3 months of the issuance of observations by SEBI.
So basically, in case of a fast track issue, now sometimes the companies can bypass all the regulations of the IPO processes. Which companies which are legally very sound companies, there is no legal case pending against them. So we'll talk about that later. So in that case, the Companies Act has specified when they can open the issue. Okay, like just read this.
For example, a company like NHAI may file a shelf prospectus to raise funds through bonds in multiple tranches over a year to finance infrastructure projects.
Now, the companies can issue shelf prospectus. Now, the shelf prospectus are issued only by financial institutions, okay? Because they may collect money multiple times from the investors. Like National Highway Authority of India has filed a shelf prospectus, and they can raise funds through bonds in multiple tranches over a period. Okay, so that is just the thing. Okay, read further.
An IPO and an FPO shall be opened after at least 3 working days from the date of registering the red-headed prospectus in case of a book build issue, or the prospectus in case of a fixed price issue with the register of company.
So that means an IPO and FPO shall be opened after at least 3 working days from the date of registering the red heading prospectus. So once your prospectus is registered and filed with the SEBI, then you can go for an opening of an issue within 3 working days after the approval has been given to you. Maximum period is 1 year, but minimum period is 3 years. So after you have got the approval, within 3 days you have to, after 3 days you can go and open your offer. Okay. Next.
If an issuer makes an IPO or an FPO other than through the book building process, desires to have the issue underwritten, it shall appoint the underwriters in accordance with the SEBI Underwriters Regulation 1993.
So now most of the companies, they go for underwriting and it has become a law. Okay, so all the companies, they must, when they come for an IPO and FPO, their whole of the issue should be underwritten by a merchant bankers. Okay, this gives basically boost to the public that in case if the issue falls, if there is no response, then the merchant bankers are going to get the shares from the company. So they are giving a strength to the IPO and FPO. Okay, read this.
If the issuer makes a public issue through a book building process, the issue shall be underwritten by the lead managers and syndicate members. However, at least 75% of the net offer to the public is proposed to be compulsorily allotted to the QIBs, and such portion cannot be underwritten.
Now, we talked about that whenever a company is issuing shares through a book build process, and in case if the company is offering 75% of the shares to the QIBs, okay, in that case that portion may not be underwritten because that portion has been actually subscribed by the large financial institutions. So only that 25% balance should be underwriting, because that will go to the either the public, the retail investors or the non-institutional investors. So the 75% money which has been offered to the QIBs should not be underwritten, because for that the money is guaranteed by the institutions. Okay, further.
The issuer shall, prior to the filing the prospectus, enter into an underwriting agreement with the lead manager and syndicate members, which shall indicate the number of specified securities which they shall subscribe to at the predetermined price in the event of undersubscription in the issue.
Now, as I told you, the lead managers or the merchant bankers, they underwrite the issue, and even the syndicate members. I have explained. The syndicate members. So syndicate members are basically the members who receive, who participate, who are basically the bankers themselves. Okay, so they can also offer themselves for underwriting the shares. So just read this: syndicate members.
Syndicate member means an intermediary registered with the board and who is permitted to accept bids, applications, and place orders with respect to the issue and carry on the activity as an underwriter. Syndicate members are commercial or investment banks, usually registered with market regulator, SEBI in India, or registered as brokers with stock exchanges responsible for underwriting IPOs.
So that means the syndicate members are also, now it is basically the merchant bankers and the syndicate members. Syndicate members are nothing but they participate in carrying out the book building process for the company, and they are generally big banks. Okay, so they can also act as a merchant banker, or they can do underwriting also. Okay.
If the syndicate member fail to fulfill their underwriting obligations, the lead manager shall fulfill the underwriting obligation.
So if now suppose what happens is that the company doesn't receive any shares, or the response is very poor. So in that case, if the shares would devolve on the underwriters, and the syndicate members don't fail to fulfill their obligation, then the lead manager should come into and take all the shares. Okay, fine. So this is what says, because there are two bodies, syndicate members and the lead manager, they are both responsible for underwriting. If the syndicate members don't fail to fulfill the underwriting obligation, then the lead managers must do it. Okay. Okay.
The lead managers and the syndicate members shall not subscribe to the issue in any manner except for fulfilling their underwriting obligation. In case of every underwriting issue, the lead manager shall undertake minimum underwriting obligation as specified by SEBI.
So basically, the syndicate members and the lead manager, they cannot participate. They cannot apply shares on behalf of themselves, except for they can take the shares but for fulfilling their underwriting obligation, but they can't participate in an IPO. Okay, but the how much portion of the issue would be underwritten, it has been specified under the regulation. So read this. Janardhan, are you there? Yeah, just read. Malaika?
Sorry, sir. What?
Okay, Janardhan can read now.
So, where the issue is required to be underwritten, the underwriting obligations should at least to the extent of minimum subscription.
So we know that there is something called minimum subscription, okay, which is 90% of the issue size, okay. So what is minimum subscription? Okay, read this, Janardhan.
The minimum subscription to be received in an issue shall be not less than 90% of the offer through offer document, except in case of an offer for sale of specified security.
So that means the ICDR regulation says that the minimum subscription, suppose the company has issued shares say for 100 crores, so company should get at least 90 crores from the public, okay, then only the offer would be, the shares can be allotted to the public, okay. So up to the minimum level, the share should be underwritten. Okay, fine. Read the second one.
In case of an IPO, the minimum subscription to be received shall be subject to allotment of minimum number of specified securities, which stipulates that at least 25% of each class or kind of equity shares or debentures convertible into equity shares issued by the company was offered and allotted to public in terms of an offer document.
So, it says that the 25% of the shares should be allotted to, the application should be at least to the extent of 25% should be received from the public. Okay. So, minimum, the law says that 25% of the issue side should be subscribed by the public and not by promoters and other classes of shareholders. Okay. Oversubscription. Janardhan?
Yes, sir. In case of oversubscription, an allotment of not more than 1% of the net offered to the public for the purpose of making allotments in minimum lots.
Now, if suppose company receives more money, okay, sometimes we know the company say that they have received 10 times than what they have, they have sought for. So, suppose for example, company came with an issue of 100 crores and they have received 1000 crores. That means 10 times more than what the shares, it has been oversubscribed. But company has to return all the money back to the prospective shareholders or the applicants. They can only retain up to 1%. Okay, just to complete the minimum allotment process. So, in case of oversubscription, the allotment of not more than 1% of the net offer to the public for the purpose of making allotment in minimum lots. Because there is a minimum lot size which is declared by the company when they go for an IPO. Okay, so I'll talk about that. So let's talk about a case study here. Okay, can you read this, Janardhan?
Company X is conducting an IPO with the following details. Net offer to the public is 10 lakh shares, 1 million shares. Minimum lot size is 100 shares.
So minimum lot size is 100. So everybody who is going to make application, it has to be in minimum lot size of 100 shares. Okay, fine. So this is the minimum lot size when the company is going to announce at the time of an IPO. Each company will have their own lot size. Okay.
Price per share is 100 rupees. Now suppose that during the IPO, company X receives applications for 12 lakh shares, which means that there is an oversubscription by 20%. Applying the 1% rule for minimum lot allotment, according to SEBI guidelines, in cases of oversubscription, a company can reserve an additional 1% of the net offer to the public to ensure that allotments can be made in minimum lots to as many investors as possible. Let's see how this would apply. 1.1% of net offer, 1% of 1 million shares is 10,000 additional. Purpose of the additional shares These 10,000 shares will be used only for allotting in minimum lots to those who might otherwise not receive an allotment due to the oversubscription. Minimum lot size. Each lot contains 100 shares, therefore the additional 10,000 shares will allow allotment to 100 additional applicants, since 10,000 shares divided by 100 equal to 100 applicants. Final allotment process. Company X now has 1,010,000 shares available for allotment. All eligible applicants will be allotted shares in a way that tries to cover as many investors as possible with minimum lots of 100 shares each. The 10,000 additional shares are specifically allocated to cover applicants who would otherwise have missed out due to the oversubscription.
Okay. Last slide of this.
Practical outcome. By using the 1% additional shares, Company X can make allotments to an additional 100 applicants in minimum lots, reducing the number of investors who are left out due to oversubscription. This approach helps distribute shares more evenly among retail investors and ensures that more people get the minimum allotment of shares rather than concentrating larger quantities with fewer investors.
So that is the whole purpose of this 1%. Okay. Okay. So I think this is on the last. Okay.
Summary of allotment. Total shares of allotment is 1,010,000 shares. Number of investors receiving minimum allotment increased by 100 due to the 1% additional shares. Oversubscription impact. The 1% buffer helps mitigate the impact of oversubscription and ensures broader participation among retail investors. The 1% rule for minimum lot allotment is a safeguard mechanism to ensure that more investors can participate in oversubscribed public offers, providing fairer access in a high demand IPO situation.
Okay, now we will just have a break, but before that, we'll just cover that. So these are some of the public issues. When the last time I made this slide during my last interaction with the students of the earlier batch. So these were some of the companies which I picked up. Devani International. Okay, do you know which company is Devyani International and what business they are doing? Anyone? Devyani International Limited. Now, Devyani International is basically, KFC, Pizza Hut. So these are owning those brands. They are the franchisees for Pizza Huts in India and KFC and some of more popular, brands like that. So they, made their first public issue or an IPO at a price range between 86 to 90, and it was an IPO oblique OFS. That it was offer for sale as well as an IPO. It was type was 100% book building, and the merchant bankers were Motilal Oswal Investment Advisors Limited, and the lot size of the share of each application was 165. Similarly, we have Life Insurance Corporation of India. The price range was 902 to 949. So it was again also an IPO or OFS. Rather, it was 100% OFS, and issue type was 100% book building, and merchant bankers were Kotak Mahindra Capital Company Limited, and lot size was 15 shares. Like we had then Burger King India, IRCTC, again with an OFS, and Paytm 197 Communications. So these were, and the Paytm merchant bankers were Morgan Stanley India. Okay, so these were some of the companies which I had picked up, and all this data is given under this site, okay, of the NSE. So okay, so before we go for the break, okay, so I've just given this link. So just because you are in your take home paper, what you are going to do, you have to choose, each one of is going to choose an IPO, okay, which has happened in say last up to 3 years or so. Okay, so you pick up this this thing and go to this site. Okay, so it will give you, so apart from the NSE site, so you will get some information on this site also. Okay, this is Screener. IPOs company listed in the last 1 year. Of course, you can make this tab up to last 2 years, last 3 years, and then you can just sort them in terms of market cap. Fine. Suppose you want to, like Hyundai Motors. This was a big automobile company. They had gone for a IPO. Okay. Bajaj Housing, Swiggy. Are you able to see that screen, Balaji?
Yes, sir.
Now, when I'm going to talk about your take home paper, so what you have to do is all the students, approximately 48 students we have in the class, each student is going to pick up a IPO. Okay, and they are going to tell what company they have chosen to Balaji. Okay, and Balaji is going to make that list within, say, when he gets all the data, and no individual should choose the same company. Okay, and they are going to choose the company and going to analyze an IPO. So I'm going to share with you what you have to do, how you are going to analyze it during today the balance period, and tomorrow I'm going to cover all that, so that you can make your project take home. And on Sunday afternoon, when we close the lecture, I'm going to declare your take home paper, so that you can start working on it. Is that clear? Any questions, please?
Sir, I have a doubt.
Yeah.
Sir, you mentioned that we can do it as a group as well. Is that still possible, or do